Hey guys, how's it going and thanks for coming. I'm Nick, this is Real Life Money, and in this video, we're going over billionaire portfolios and what they're investing in for a possible 2020 stock market crash. We're talking big guys. We're talking Ray Dalio, Tudor Jones, those are both hedge fund managers, and also Warren Buffett. If you don't know who Warren Buffett is, do a little bit more research. And also Charlie Munger, a partner of Warren Buffett. So they're all billionaires, and we're going to be diving into exactly what they're investing in. And at the end, we're going to be talking about possibly why they're investing in some of these different investments, because we're going into a possible correction, depression, recession, whatever you wish to call it, but a lot of people are watching out for a possible crash. So if you just want to look at billionaire portfolios, that's always fun. But if you're too scared to watch the end, which some actual truth and facts to it, then you could skip that part. I'm just going to go quickly over that because it seems like no one even cares about it. So why should I dive deep into it? But we'll see if you're interested. So let's just start this off with some billionaire portfolios. So we're first starting off with the largest hedge fund manager in the world. A lot of people love listening to him because he's a smart guy, is Ray Dalio. This holding was around the end of the year, around like November or so. So it is a few months old. However, you could still see his portfolio allocations. He is big into the all-weather portfolio, definitely diversifying. So not only American companies, but also international and bonds and other types of investments. So let's see if he practices what he preaches. So his portfolio consists of the largest percentage is the S&P 500. Right now it's around 18%, so that's a pretty big holdings. Then you could see he gets into emerging markets. So there's his diversification, around 13%. And this was actually pretty interesting because I remember, I think I did a video on this probably a few months ago, but his largest percentage was actually international. And recently, now his largest percentage is American companies. Interesting switch. So moving on from here, you could see he goes into more diversification like he preaches. He does have emerging markets ETF, so that's just diversifying even more, 7.5%, even more into American companies, so that's 5.7%, and gold. Ray Dalio is one of the people out there that says that you should own gold in your portfolio. Recently talked about how cash is trash, and if a collapse does end up happening, gold maintains its value. And since dollar decreases, gold increases relative to the dollar. So he does suggest some gold, and that's exactly what he has. Also interesting is Brazil. He has some 4.7% emerging markets, and then he does get into corporate bonds. So corporate bonds does give you a little bit more of a dividend, so that helps your return bit there. And also with his 20+ year treasury bonds, and at the end high yield corporate bonds. So at the ends are more bond specific with those higher yields. So Ray Dalio, very interesting, definitely diversified across basically every space. Now another hedge fund manager is Tudor Jones. Let's see what his investments consist of. So very interesting that he has exactly the same top holdings as Ray Dalio is the S&P 500 index. So that consists of almost 11%. And by the way, you can see that this filing date was November, so similar to Ray Dalio. So it's a few months old, but it still has the same consistency, relatively speaking. Then he goes into actually specific companies, where Ray Dalio had ETFs and funds, very diversified. Tudor Jones has more stock specific. So you see Celgene, that's biopharmaceuticals, SunTrust Bank, so finances. Then you see he has a couple more biopharmaceuticals. He has Disney Corporation, Microsoft, more banks, Amazon, and these all consist of, between 1 to 5 or 6% of his portfolio. Then it goes into some other companies. One interesting holdings is iShares TIPS bond ETF. It is relatively small, 0.6%. And he also has Oracle, United Healthcare, Starbucks, and some other guys. Now I did want to point out the TIPS holdings that Tudor Jones did have TIPS stands for, I want to get this right, Treasury Inflation Protected Securities. So you would hold this if you're expecting some massive inflation, because if there's more inflation, then there's more yield on the TIPS bond. So it's interesting that he's holding that. But overall, his portfolio does consist of a lot of American companies, kind of focusing on biopharmaceutical or biotech, some growth in there, and also banks. Talking of banks, we're going to be talking a lot about those at the end to see what's actually going on. But you don't have to stick around till then, only if you want to know the truth. Now, if you haven't heard of Tudor Jones, he's actually close friends with Ray Dalio. He does have an ETF if you want to follow him. It's Just Capital. You could see the holdings right there. Another very smart individual. He actually predicted and profited largely from the crash in the 80s. So definitely look into him if you haven't heard of him already. So we talked about hedge fund managers. What about some other billionaires like our guy Warren Buffett? So let's see what he has holdings. He has individual companies. Largest one is Apple, 26% of his portfolio, which is massive. You could see Bank of America, over 12.5%, which is still massive. Coca-Cola, of course, probably one of his most famous investments. Wells Fargo, he also has US Bank Corp and JP Morgan, all financials. You can see he owns 44% of his holdings is in financials. We will talk about this later. However, some of the other main ones, he has American Express, Kraft Heinz, which is down like 60-70% since it came out like few years ago. Also has some airline stocks in there. But you can see that he has specific companies. He's been holding them forever. A lot of them, well, most of them, if not all of them, definitely have dividends behind them as well. So they do have growth, but also that dividend yield for passive income for him. Now, something that completely surprised me when I looked into his friend Charlie Munger, his personal portfolio, which is something very interesting. Let me know if you knew he invested like this, or if you knew any of these billionaires invested the way their portfolios are set up, because some people might say things and do things differently. That's why we want to look at what they're doing. So our friend Charlie Munger only has a couple of holdings. He has Wells Fargo, Bank of America, US Bank Corp, and POSCO. Over 99% of his holdings are in banks. So going from Ray Dalio, which is massive diversification, going to Charlie Munger, which is all banks, all day, all the time, no diversification whatsoever. And it's actually interesting because I remember watching an interview of him. He wishes he bought more banks back in 2008 with Warren Buffett because they returned fantastically. So quick overview of these billionaire investors. You could see they all have different strategies, yet at the same time they're all billionaires. So there's no like one set strategy that works. It really is what you're comfortable in, what you're focused in, and just keep doing what your plan is. So you do see the differences of, hedge fund managers kind of have a lot more diversification, where the billionaire, they're all billionaires, but Buffett and Munger have specific companies. Now, similarities is that, and especially it's very interesting because everyone's talking about crashes and how the American economy is overblown in a bubble, yet these billionaires are still investing in them. The hedge fund managers, their largest portfolio or largest holdings in their portfolio is American businesses. At the same time, you could also see large percentage of these portfolios, of all of these portfolios, are in financials, the banks. So before talking about what's really going on, and specifically with the banks, is which of these billionaires do you find yourself more in line with? Ray Dalio is definitely diversification across basically everything, where Charlie Munger is just stick with what you know, and that's basically it. It's no right or wrong answer, but there are multiple strategies. What do you consider yourself? But now, the possible truth revealed in the open. Beware of what could actually be happening in the financial sector in the US economy. So let's talk about that. If you want to keep learning about what's actually going on, please stick around. But if you want to leave, go ahead and leave. This is the time to leave if you don't want the truth. Because, yeah, it's going to be a little boring. No one really cares because no one talks about it. But I'll try. So everyone's talking about a bubble, a crash, a recession, or depression in the near future. I mean, people talk about this every single year. However, eventually, it will happen. When that eventually will come, no one really knows. But people are talking about bubbles because of, I'm going to be showing a lot of different charts. I love charts and stuff like that. So some of the main reasons why we're possibly in a bubble, I'm going to remove that possibly out of there because we are in a bubble. When it will pop, nobody would know. But however, you can see since the 80s, interest rates have been declining. Now there have been ups and downs, but overall, it is a downwards projection. Especially starting in 2008. That's when the recession happened. They dropped rates down low to nothing, and a lot of buying was occurring. Asset prices were low, so they just kept buying, and that's what ended up happening. So you could see that here, and they only started recently increasing rates. However, they stopped that. That was actually when it was like the end of the year, maybe November, December of 2018, I believe it was. The market was dropping because the Fed started to sell off assets. Well, since the market was crashing, they actually decided to completely stop that. So they reversed course, dropped interest rates for supposedly insurance reasons, and the market has been going up ever since. However, what was happening recently, even more concerning, is a chart like this. Now, whether you want to understand finance or banking or anything, you don't even have to understand what this chart has to do or say. All you see is that spike, and you would question, what the heck is that? So what the heck that is that banks lend to each other overnight for operation purposes. They need, certain reserves on balance sheet and what have you. So their rates were fairly flat. Then all of a sudden, it spiked. So this chart, it said average was maybe around 2.5%, and then it spiked to over 5%. I also heard other sources it was close to 10% too. However, there's no doubting there was a spike on that day. That day was mid-September. So since the interest rate spiked, this is the repo market, that the banks were not comfortable lending to each other. So that has a concern in liquidity. Well, the Fed was late to this. However, they started injecting money into the repo market to have more liquidity for the banks. It seems complex. I'm going to try to simplify it as much as I can. At the end, I'll do a quick overview of what all this could mean. However, this is another chart of repo operations. You could see the repurchase agreements of the Fed. There were no repurchases of the Fed since the last recession, and all of a sudden it spiked. Interestingly enough, in mid-September when those rates spiked. So the Fed was pumping money into the repo market for the banks so they could be more liquid. Supporting evidence of this is you can see the total assets of the Fed's balance sheet in this chart. So you can see obviously since the recession in 2008, they were pumping huge amounts of money and increasing their balances. And ever since around like 2014, 15, they started evening out. Then they started to decrease their balance sheet. Well, that didn't work, and interestingly enough, they reversed that plan middle of September, increasing their balance sheet to pump money into the repo market for the banks. So quick overview. Let's take a breath for a second. A big one. Let's do a quick overview of what this even means. So the Federal Reserve is increasing their balance sheet to pump the repo market filled with money for the banks to then keep those interest rates low so there are no spikes. So with that downward projection of interest rates, it would increase the bullish factor in the stock market so people will continue buying into the market. Hopefully that kind of makes sense. It makes no sense at this point that stocks keep going up. Nothing makes sense anymore. People are worrying about a collapse. However, prices still go up. And this could be one of the main factors to that. And you could see that these billionaires have their funds in US stock market and in financials because they're going up, because the Fed is pumping the markets, and it's basically a reason why these billionaires to invest in it, because they're going to make money. And looking at the Fed funds rate, each recession there's actually an average rate cut of 5%. You could look at the chart. There were a couple of recessions, past recessions, like one was in the 90s, 2000s, 2008. Each of those recessions was a cut of 5%. Well, the concern right now is we're around 2.5%. If we cut that 5%, we're in the negative, just like the rest of the world. In a messed up world, that's actually bullish, because when rates decline, then their prices, their values increase. However, at the same time, who in their right mind will invest in a negative rate? So hopefully I simplified it enough. It is kind of complex if you want to watch that over. However, overall view is we are all almost expecting a crash soon. However, we are still, including the billionaires, bullish on the stock market for this reason. More money and liquidity from the Fed into the banks, jacking up the prices. And a little food for thought for those who are thinking there's not a correction coming on. The economy is fine. Look at the unemployment rate. That says it all. Well, if you look at the unemployment rate, by the way, it's the lowest before a recession, so that's actually a concern. And at the same time, if you actually believe the unemployment rate that they're actually giving us, then that's another thing. The unemployment rate is around a 3.5. However, that's the U3 number. There's another U6 number, which includes part-time workers, underemployed, or people that have just started looking. It still doesn't include people who just straight up gave up. That number is actually a 6.8%. However, something that actually shows you we might not be in a booming economy is the labor force participation rate, which shows you ever since 2008, this shows you the percentage of people that are actually working. It has been down since 2008. That means there are less people working now than in the recession in 2008. So since then, less people have been working. That doesn't seem like a booming economy comparing to this chart right here. So that's just food for thought. Let me know what you guys think. If you have any questions, comments, concerns, please leave them down below. But I think the things I brought up are very interesting and something to look a little bit further into. If you're a nerd like me and want to do that, there's actually another channel I recently found out. Love his videos. Would definitely recommend him. His name is George Gammon. I'll leave a link in the description. He talks about like central banks and what they're actually doing to the economy. So I get worked up with this stuff because no one's talking about it, or a very small percentage of people are. So thank you so much for watching, guys. Really appreciate it. I'm exhausted now, and I'll see you in the next one.